Welcome to my presentation, Property Valuation for Beginners, Part 5. It's quite a long time that the Part 4 was presented, and there is a gap between the Part 4 and the present one. So, just to recollect your memory and for a mindset, we will just recap what we have done in Part 4. In the fourth part, we covered valuation approaches and methods. Income approach, under which the income capitalization method or investment method. Then discounted cash flow method. Then the profit method. Then the case studies of simple interest, compound interest, years purchase. And under income approach, freehold properties, owner-occupied property, then freehold subject to lease. Now, in this chapter 5, we are planning to discuss freehold properties subject to lease at market rent with rent review clause. Then the TDR concept, transfer of development rights, rent capitalization method. Then the case studies of valuation under market approach and valuation under cost approach. Introduction. This is the continuation of the property valuation for beginners part 4, in which we were dealing with income approach method for valuation. Under income approach, there are freehold property and leasehold property. Then under the bifurcation of freehold property, there are owner-occupied property, that is vacant property. Then freehold property subject to lease. We have covered freehold and owner-occupied property in this chapter. In this chapter, we are discussing freehold property subject to lease and leasehold property. Freehold property subject to lease at market rent with rent review clause. In the earlier chapters, we have been following the principle that value is equal to years purchase into net income. This is the formula that is used for the valuation of income producing properties. As explained in earlier chapters, the income from a freehold property is always perpetual. In the present condition, for freehold property subject to lease at market rent with a specific clause, rent review clause, also we follow the same method but with two variables, net income and yield. The yield is defined as the rate of capitalization of the net income to arrive the value of the property. In the case of freehold property, net income arrived at by deducting the outgoings from the gross annual income. The yield, that is the rate of capitalization, has to be decided depending upon the net income. It depends upon the net income increase in a more faster way when compared to the average rate of increase. Then the yield selected should be low and the location of the property should fall on prime location. In secondary location, the income growth will be average or even below average, and hence the yield selected should be higher than the rate selected for a prime location. For incomes from a property which is static for a long time, the yield selected should be the highest. All these rules governing the selection of yield is solely due to the domination of inflation over the investment in the property. The procedure followed for valuing freehold property subject to lease let out at market rent is the same as followed in the case of owner-occupied or vacant property, vacant freehold property. This can be understood in a more simpler method by studying the following case studies. Case studies. Case 1. In the prime location of a city, two office units of modern standards in a block of offices are let out in suits for a gross rent of rupees 35 lakhs per annum for 30 years, have been let out to a reputable company. The rent reserved is a full market rent of the properties where the freeholder is responsible for the external and structural repairs and maintenance, insurance, property tax, and management. The structure is in good condition and good maintenance. There is a rent review clause for 5 years at full market rent. These lease terms are appropriate for a notional lease as is typical for the type of the property in the present market. The freehold yield from similar investment associated with 5-yearly rent review clause to market rent is 5% at present. Now coming to the problem, calculate the value of the freeholder's interest in the property. Gross market rent, FRV, is equal to rupees 35 lakhs. Less outgoings of landlord. These are for evaluation purposes. This may vary by 10% to 50% in actual practice. Now, in this problem, we are assuming this outgoings since it is not given in the question. So, 1. Repairs and maintenance, 10%. 2. Insurance, 2.5%. 3. Property tax, 15%. Then management, 7.5%. So total deductions comes to 35% is equal to rupees 35 lakhs into 0.35 is equal to rupees 12 lakhs 25,000. So net income is equal to rupees 35 lakhs minus rupees 12 lakhs 25,000, which is equal to rupees 22 lakhs 75,000. Year's purchase as given at 5% in perpetuity is equal to L by R is equal to, it is 1 by R is equal to 1 divided by 0.05 is equal to 20. So the market value is equal to net annuity into year's purchase is equal to 22 lakhs 75,000. That is the net annuity into the year's purchase, which we have calculated as 20, which is equal to rupees 4 crores 55 lakhs. The following points may be noted for your guidance. 1. The property is in a prime location meeting all modern facilities and the property is in sound condition and well maintained and all repairs done. As per the agreement condition, there is rent renewal clause every 5 years to a market rent level. Hence, the growth rate of the income is at a faster level than the average rate of increase. It is evident that the rate is 5% when compared to the gift-edged security is 7.5%. Though the term of lease is only a short period of 30 years, the general procedure of valuation of term plus reversion, as in the case of properties let out below market rent, is not resorted. The reason being, the lease rent will be brought to the market rent every 5 years and at the end of 30 years through the 5-yearly rent review clause. So may be valued in perpetuity even after the present lease period of 30 years is over. Case 2. A stationery shop situated in a prime locality has been recently let out to a reputed trader in full market rent on exclusive terms with 5-yearly rent review clause for 20 years. The full market rent of the shop is Rs 75,000 per month. These terms are appropriate for a notional lease typical of this type of property in this locality. Find out the freehold value of the property. Gross market rent is equal to Rs 75,000 into 12 is equal to Rs 9 lakhs. Deduct outgoings of the landlord on exclusive terms of conditions. It is 0 since this lease is on exclusive terms and conditions. So net income is equal to 9 lakhs. Assume a year's purchase at a yield of 3.5% since the property is in a prime locality. Here you should know, if the property is in a prime locality, the yield will be at a lesser rate, say 3.5%. If it is in a secondary place, this yield, the return will be at a higher rate by 7%. Year's purchase is equal to, at 3.5% is equal to 1 by R is equal to 1 divided by 0.035 is equal to 28.571. So the market value is equal to the net annuity into year's purchase. So 9 lakhs into 28.571 is equal to 2 crores 57 lakhs 13,900. Please note the following points. 1. Though the shop is let out for a period of 20 years lease, it is under the assurance that it is brought under the market rent on review after every 5 years. So the income may be taken as the income in perpetuity, because every 5 years the rent will be renewed as per the market rent. Second, the shop is in a prime locality and hence the yield is very low, 3.5%, which is found on investigation in the locality, which shows a reverse yield from gifted security being approximately 7.5%. Case 3. A shop situated in the outskirts of a town in a secondary location has been recently let out to a vegetable dealer at a market rate of 6,000 per month. As per the understanding, the landlord pays all outgoings. The rent fixed is the market rent of the property. As per the lease term, the shop is let out for a period of 10 years with a 5-yearly rent review clause. These terms and conditions are appropriate for a notional lease typical for the type of property in the present market. Find out the market value of the property. Gross market rent is equal to rupees 6,012 is equal to rupees 72,000. Less outgoings. 1. Repairs and maintenance 10%. Insurance 1.5%. So total outgoings is equal to 30.5%, which is equal to rupees 72,000 into 0.305 is equal to rupees 21,960. Net income is equal to rupees 72,000 minus 21,960 is equal to rupees 50,040. Considering an annual return of yield of 10%, since it is in a secondary location, years purchase at 10% in perpetuity is equal to 1 by R is equal to 1 by 10 is equal to 10. So market value is equal to net income, the annuity into years purchase, that is rupees 50,040 into 10 is equal to 5,400,000. Hence, note the following points in this problem. The shop in question is located in a secondary location. Hence, the rate of rental growth will be low. The landlord bears all the burden of all the outgoing. This results in the landlord's income becoming uncertain. Considering all these aspects and enquiring the conditions of similar property transaction in the secondary location, the yield is chosen at a much higher rate of 10%. This is much higher than the rate for a prime location in the previous example. But there is a rent review clause, and so the property is brought to market rent every 5 years. Hence, the income may be capitalized in perpetuity. Now, valuation of leasehold properties and rent capitalization case studies. Case 1. Find out the value of freehold interest of a shop which has been let out on a rent of 1,25,000 net per month. The rent is renewable and assume the yield as 6%. Annual rent is equal to rupees 1,25,000 into 12 is equal to rupees 15 lakhs. Net annual income is equal to 15 lakhs. Years purchase for a yield of 6% is equal to 100 by 6 equal to 16.67. So capitalized value is equal to 15 lakhs into 16.67 is equal to 2 crores 50 lakhs and 5,000. Case 2. A freehold plot is rented out for a period of 99 years to a developer at a ground rent of rupees 1,20,000 per annum after outgoings. That is the net annual income. And the lease is renewable. The developer, who is the lessee, has constructed shopping complex which is fetching an annual rent of 6 lakhs per year. Value the lessor's interest assuming the yield at 7%. Value in the hands of the lessor. Net income from the ground rent is equal to rupees 1,20,000. Rate of return or yield is equal to 7%. Hence, years purchase in perpetuity is equal to 100 by 7 is equal to 14.285. Value in the hands of the lessor is equal to rupees 1,20,000, that is the net annuity, into years purchase 14.285 is equal to rupees 17 lakhs 14,020. Case 3. A government-controlled quasi-government organization leased the industrial plot of area 5,000 square meter to a businessman in the year 2000 for a period of 99 years by charging a one-time premium of rupees 500 per square meter. The lease rent was fixed at rupees 1 per year. This businessman built a garment making factory of built-up area of 2,500 square meter in the plot costing 75 lakhs in the year 2000. The prevailing land rate as on 2019 is rupees 1,500 per square meter, and the replacement cost of the factory building in the year 2019 is 24,000 per square meter. The total life of the factory building is estimated as 45 years. As per the lease agreement, the leaser is entitled to change 50% of the unearned increase in land value as transfer assignment charges in the case of the sale of the transfer of the property. Find out the following details. 1. The leaser's interest in the property in the year 2019. 2. What is the lessee's interest in the property in the year 2019? What is the depreciation amount of the factory value in 2019, assuming a straight line method of depreciation and salvage value of 10%? Fourth, what is the market value of the property in 2019 if land was not of leasehold tenure but freehold tenure? Coming to the problem, the data available. Lease period 99 years. Year of commencement of lease 2000. Land area 5,000 square meter. Built up area of the factory built by lessee 2,500 square meter. Year of construction of the factory 2000. Cost of factory building is equal to 75 lakhs. Land rate as on 2019 rupees 1,500 per square meter. Replacement cost of the factory building rupees 24,000 per square meter. Total life of the factory building 45 years. One time premium paid by lessee rupees 500 per square meter. Land rent rupees 1 per year. Lease conditions. Lessor has the right to charge 50% of unearned increase in land value in case of sale of transfer. First, the lessor's interest. Here, the lessor's interest is the capitalized value of the lease rent and the 50% of the unearned increase in land value in case of sale of or transfer. The lease rent is very nominal, namely rupees 1 per year, and hence it is negligible. Hence, the leaser's interest is only the 50% of the unearned increase in land value. Land area is equal to 5,000 per square meter. Land rate in 2019 is 1,500. One-time premium paid by the lessees in 2000 is 500 per square meter. So here, unearned increase is equal to the land rate in 2019 is 1,500. The land rate at the time of purchase is 500 per square meter. So 1,000, the unearned income or unearned increase is equal to 1,500 minus 500 is equal to 1,000 per square meter. The percentage the leasers is entitled to charge in case of transfer is clearly mentioned as 50%. Unearned increase in the leaser is entitled to 50% of the total area into the increase in unearned income 1,000 per square meter. So the unearned increase the lessor is entitled to is equal to 0.5 into 1,000 is equal to rupees 500 per square meter. That's equal to amount entailed to the lessor is equal to 5,000, the area of the land, and the unearned increase for the lessor is 500 per square meter is equal to rupees 25 lakhs. Case 5. An industrial undertaking has decided to lease a industrial plot of 50,000 square feet for a period of 60 years. The land rate is 3,000 per square foot. Assuming an yield of 7%, what will be the monthly lease? Extent of land 50,000 square feet. Prevailing land rate is 3,000 per square foot. So the value of land is equal to 50,000 into 3,000 is equal to 15 crores. Yield is equal to 7%. So the annual rent is equal to 15 crores into 0.07 is equal to 1 crore 5 lakhs. So the monthly lease rent is equal to rupees 1 crore 5 lakhs divided by 12 is equal to rupees 8 lakh 75,000. Now surrender and renewal of lease. Surrender and renewal of lease is a rare feature because of the strong Rent Control Act is prevailing in the country. Still, there are instances of surrender and renewal of lease. There are also many cases of renewal of lease by public authorities, but they are mostly on public interest and does not involve rent based on market rent. Even though the instances are not very common, it is better that the valuer is aware of this method of valuation in the case of surrender and renewal of lease because the value may be consulted by the lessor for any advice regarding the revised fair lease rent or premium to be collected. The renewal of lease is generally by private landowners, that is leasers, or public body landowners like municipal corporation, electricity board, or any quasi-government organization, and sometimes by government itself. 1. Renewal of lease. At the time of the close of the expiry of the existing lease, especially commercial properties, often approaches the lessor to obtain an extension or renewal of the lease, surrendering the unexpired period of the lease so that the lessee can continue to get benefit of the goodwill earned by them by carrying out their long-running business for a period specified in the original lease, or for a specified period mutually agreed by the lessor and the lessee. At the time of renewal of the fair market rent, may be more than the lease rent agreed on the past, in which case the lessee will have to compensate the lessor for the proposed extension, and the form of compensation in a matter of understanding and agreement between the lessee and the lessor. The first renewal lease may be as per the same terms and conditions of the existing lease. And in that case, the lessor will have to be compensated by payment of a premium, or alternately, the lessee may be required to pay a higher rent, or he may be requested to pay a higher rent and a premium. If otherwise, the lessee is surrendering the unexpired period of lease and thereby foregoing the profit rent, that is the remainder of his interest in the property. He should be compensated for the same. The compensation can be worked out from the lessor's side or from the lessee's side as per the same principle for both. 1. Estimating the value of the party's interest in the property as if under existing lease. Secondly, estimating the value of the party's interest, assuming that the proposed renewal of the extension has been granted on new terms and conditions and mutually agreed upon. The difference between the two values will indicate the extent to which the lease will gain and the extent to which the lessor will lose on account of the proposed renewal or extension. It is also possible that the final figure will be close to the lower figure of the two. The premium to be paid will be suggested by the difference between the two values. In other case, if the parties agree to pay a higher rent instead of a premium, then the revised rent can be worked out by adding the annual equivalent of the difference between the two values to the present rent. In reality, the estimates of revised rent or premium from the lessor's point of view usually differ from that estimated by the lessee's point of view. And what is followed generally is the figure that is finally arrived at by negotiation. The above theory will be understood more precisely by going through the following examples, the case studies. It must be taken into consideration that these case studies are pertaining to built-up leased premises. The rental value of the premium. The procedure is the same for the rental value or premium amount for the first time or for renewal or for extension. These estimations are worked out on the presumption that Rent Control Act is not applicable, but Transfer of Property Act is applicable to the property. In places where Rent Act is enforced, the question of increase in rent or additional premium does not arise at all. Case studies. Case 1. Calculate the premium to be paid by a lessee for a renewal of lease for a shop premises for a further period of 35 years on condition that the existing rent is not changed. Existing lease rent about to mature is rupees 25,000 per annum. The fair rent of the shop premises is rupees 35,000 per annum. Value of lessee's interest to be calculated at 8% and 3%, and value of a leaser's freehold interest to be calculated at 7% as per the details of local property market. First, the lessee's interest. The present fair market rent is equal to 35,000 per annum. Rent to be paid to the lessor as per existing is rupees 25,000 per annum. Profit rent to the lessee per year is equal to 10,000 per annum. Years purchase for 35 years at dual rate of 8% and 3% is equal to 1 divided by R plus S. So rate of return is equal to 8%, and sinking fund is equal to R by 1 plus R the whole raised to n minus 1. That is equal to 0.03. That is the 3% divided by 1 plus R is equal to 1.03. The raised to 35 minus 1 is equal to 0.03 divided by 2.8138 minus 1 is equal to 0.03 divided 1.8138 is equal to 0.0165. So 1 divided by R plus S is equal to 1 divided by 0.08, the 8% rate of return, plus 0.0165, the sinking fund. That's equal to 1 divided by 0.0965, which is equal to 10.36. Revised premium that can be paid to the lessor is equal to rupees 10,000. The profit rent the lessor may get is into 10.36 is equal to rupees 1,03,600 per annum. Now, the lessor's interest. Present position of fair market rent is equal to 35,000 per annum. Years purchase in perpetuity at 7.4% for 35 years is equal to 1 by R is equal to 1 by 0.075 is equal to 13.33. If no premium is taken for renewal, value of lessor's interest is equal to 35,000 into 13.333 is equal to 4,66,655. If the proposed lease rent is to continue at rupees 25,000 for 35 years, years purchase for 35 years at 7.5% is equal to 1 minus PV by R is equal to 1 minus 1 by 1 plus R the whole raised and divided by R. That is the amount which you will receive in 35 years. What is the present value? That is 1 minus PV by R. That is equal to 1 minus 1 by 1.075 the whole raised to 35 divided by 0.075 is equal to 12.27. Value of lessor's interest is equal to 25,000 into 12.27 is equal to 3,06,750. The lessor is also eligible for the present worth with full rent of rupees 35,000. So present worth of 35,000 per annum at 7.5% for 35 years is equal to deferred payment of rupees 4,66,655 is equal to the deferred payment of 4,66,655 is equal to rupees 4,66,655 into 1 by 1 plus 0.075 the whole raised to 5. That is equal to 4,66,655 into 0.0796 is equal to rupees 37,146 per annum. Total value of leaser's interest is equal to the second plus 3 is equal to 3,06,750 minus 37,146 is equal to rupees 2,69,604. From lesser's point of view, the premium receivable is equal to 1 minus 4 is equal to rupees 4,66,655 minus rupees 2,69,604 is equal to rupees 1,97,051. Here, from lessee's point of view, the maximum premium to be paid will be rupees 1,03,600. But as per lessee's point of view, the premium chargeable is 1,97,051. Here a compromise is required to arrive at the amount of premium. It can be rupees 1,10,000. It is not the average of the two figures. It is usually closer to the lower value. Here you should understand whatever be the calculations and theory, the practical approach and what is possible is a negotiation between the leaser and the lessee. Only the negotiation should work out, and here you can keep in mind the principle that it is not the average but it is to the closer to the lower level. So negotiation is the best approach in this problem. Case 2. A godown is held on lease having unexpired period of 10 years at rupees 2,50,000 per annum. The present market rental is rupees 4 lakh per annum. The lessee is willing to spend an amount of rupees 8 lakhs for improvement, renovations, modification. Thereby the increase in the fair rent will be 1,50,000 per annum, provided the lessor will accept surrender of the present lease and grant a new lease for a period of 30 years. The lessee is prepared to pay a reasonable rent under the new lease or by a new premium. The lessor is prepared to execute a new lease agreement with the rent rupees 2 lakhs per annum and agreed to grant a new lease if the lessee is prepared to pay proper premium, that the new lease agreement contains a covenant that the lessee will carry out improvements as promised. Advise the lessee on the amount of premium to be paid considering that this rent is rupees 2 lakhs per annum. Now, lessee's view. First, the proposed interest of lessee is the profit rent. Market rent is equal to 4 lakhs per annum. Add increase in rent due to improvements, rupees 1,50,000. So equivalent rent is equal to 4 lakhs, the market rent plus the rent on improvement, which comes to 5,50,000 per annum. Less rent under new lease agreement is rupees 2 lakhs. So profit rent is 3,50,000 per annum. Value of the profit rental is equal to annual rent into years purchased for 30 years. Years purchased for 30 years at 12% and 3% is equal to 1 divided by R plus S. R is the rate of return and S is the sinking fund at 3%. So sinking fund is equal to R divided by 1 plus R the whole raised to n minus 1 is equal to 0.03 divided by 1 plus 0.03 the whole raised to 30 minus 1 is equal to 0.03 divided by 1.427, which is equal to 0.0210. So the year's purchase is equal to 1 by 0.12, that is the rate of return, plus the sinking fund calculation 0.021 is equal to 7.0921. So value of the profit rental is equal to rupees 3,50,000 into 7.0921 is equal to rupees 24,82,235. Deduct expenditure on improvements at rupees 8 lakhs. Value of the proposed lessee's interest is equal to 24 lakhs 82,235 minus the improvement cost of 8 lakhs, which is equal to 16 lakhs 82,235. This is lessee's interest. Present interest at lessee. Market rent is equal to 4 lakhs per annum. Rent paid is 2,50,000. Profit rent is 1,50,000 per annum. Years purchased for 10 years at 12% and 3% is equal to 1 divided by R plus S, which is equal to 0.03 divided 1.03, the whole raised to 10 minus 1 is equal to 0.03 divided 0.3439, which is equal to 0.0872. So 1 divided by R plus is equal to 1 divided by 12%, that is the rate of return, and the sinking fund 0.0872 is equal to 4.826. So value of the present interest is equal to 1,50,000 into 4.826 is equal to rupees 7,23,900. Total probable gain for lessee is equal to 16,82,234 minus the present interest 7,23,900 is equal to 9,58,335. Now we are taking up the concept of transfer of development right concept and the development right. TDR, the transferable development rights. One's right can be transferred. It can be transferred to the same place or to another place. The government found it very difficult in finding land for development works. Also, the local authority had shortage of funds for acquiring land and for providing infrastructure amenities in the area acquired. So a suggestion came from the builders involved in the development works as well as the government. A new idea that land required for public amenities could be made available free of cost at the local authority provided special extra initiative is given to the owners and builders in the form of extra FSI on their other lands. Because of the new idea of concept, the TDR became a popular with the authorities and the developers. It was first introduced in India in the year 1991 in the city of Mumbai. When DC Rules 1991 came into force, under which TDR is granted in lieu of compensation for loss of land. The new concept has been introduced in other towns in India, and this is termed as the transferable development right. Generally, the owner of the plot holds the right of development which is attached to the plot of the land owned by him. But under this TDR concept, owner of the plot retains the right for the development which is detached from the plot owned by him. This right is transferable and it can be attached by not belonging to the owner. The only condition is that the land reserved for public purposes or roads has to be handed over free of charge and free from encumbrances to the local authority, and lieu of the land surrendered free, the local authority will award TDR rights which are tradable in the open market. Thus, the owner loses the ownership of the land, yet he continues to hold the development right of the surrendered land, which is transferable only to the lands in receiving zone, and these rights are saleable in the open market. The following terms connected with TDR will be very useful for the valuers. 1. Originating plot. The plot of land which is reserved for the public purpose or development of road under a development plan when surrendered free of cost and free of any encumbrances to the local authority by the owners of the said plot is called the originating plot. Then the receiving plot. The plot of land on which the extra FSI is permitted to be developed by use of TDR is called the receiving plot. 3. Development Rights Certificate or DRC. The document or the instrument issued by the local authority to the owner of the surrendering plot in lieu of the free of cost and free of encumbrances. Surrender of the said plot to local authority is called the Development Rights Certificate. 4th, Development Right. When part of the plot is affected by reservation and development rights used by same plot owner on remaining adjacent portion of the land plot, it is called the development right. Valuation of TDR. In practice, the valuation of TDR owned by the originating plot owner is very difficult due to the different norms and several restrictions. Since the TDR is being used on several other plots in different wards and different locality, where land rates would be quite different. It is a known fact that rates of land prevalent in the originating plot locality is of little help in the valuation. The rates of the land in the receiving zone may be higher or lower, generally lower, than the rates of land in the originating plot. Also, in TDR, there are some complex issues in the interest of the persons involved. The three persons interested in the TDR value. In practice, we find there are three persons interested in TDR value, and hence the TDR value has to be divided among these three interested persons. One, the owner of the originating plot is interested to receive compensation for loss of development rights for the plot surrendered free of cost to the local authority. Two, the developer is the investor who buys the TDR for the development and make profit out of it. He is the main person who takes all responsibilities and investment to purchase the TDR and utilize it in the receiving plot by increasing the FSI or constructing an additional floor in the existing construction. Third, the third person who is interested is owner of the receiving plot. Due to the extra development due to the TDR, there would be more occupants in the property. The existing amenities like water, drainage amenities like garden, playground, parking facilities, swimming pool will be overcrowded. Payment made to receiving plot owners for giving permission to load TDR is many a time called the royalty amount. Due to these three interested persons, it is very difficult to apportion the share of each person in the value of TDR, and it is really a tough job. The share of interested persons in the value does not remain same in every case, but differs depending upon circumstances. In the valuation of TDR, among the three interested parties, the following main points are considered. A. Value of land in the locality of originating plot. B. Value of the land in the locality of receiving plot. Share of profit expected by developer for undertaking the development project. D. Supply and demand for TDR in the real estate market at the time of occurrence. E. Bargaining power of the three interested parties. Case study 1. For our evaluation, let us assume the value of the originating plot is higher than the land value of the receiving plot. Taking land value of receiving plot as basis, TDR value could be divided as under. A. 55% share in value to originating plot owner and is called compensation value. 20% share in value to receiving plot owner called the royalty value. 25% share in the developer cum investor called the profit value. In the above division, the item C, 25% share is considered, which may be divided between the developer and the investor because some brokers cum investors buys TDR and hold it with the sole motive to sell the TDR at a higher price when there is scarcity in the market. In the above division of the share between these interested persons, it may appear that 55% share for the originating plot owner is too low. Here, you have to consider the facts prevailing in the real estate market, that the plot owners are quite satisfied with this share due to several reasons. Compensation under acquisition cases are too low, even with considering the 30% scholarship. To get the higher value, the plot owner will have to fight in the court for too many years to prove the higher value. Their full price will be received only after 15 to 20 years of legal battle, whereas TDR value is immediately receivable. This is the reason they accept the 55%, though it is a low value. Case study 2. There are cases where originating plot has a lower land value, whereas receiving plots have a higher land value. In such condition, basis of TDR value has to be value of receiving plot only. And consequently, the share of three interested person would change drastically in such case and will be changed to share will, and the changed share will be as under. A. 35% share value to originating plot owner, compensation value. 20% share in value to receiving plot owner, royalty value. 45% share in value to developer come investor, that is the profit value. Examples in TDR values. Case 1. Owner of a plot in Kavadiyar and Trivandrum surrendered a plot to local authorities and obtained TDR for 2000 square meter plot. FSI plot is 2.5. The plot is residential zone and land rate is 65,000 per square meter. TDR usable in Vadakad, where land rate is 25,000 per square meter and FSI is 2. Find the value of TDR receivable by the originating plot owner. Since the land rate in originating plots is higher than the land rate in the receiving plot, the land value of 25,000 square meter taken as base and shares are proposed under. %25% receiving plot owner. So 25,000 point is equal to 5,000 royalty. 55,000 originating plot owner, 25,000.55 rupees, 13,750. 25% developer share, rupees 25,000 into 0.25 is equal to 6,200 rupees profit share. Value of a TDR to owner is equal to 2,000 into 2.5 into 13,750 is equal to 6 crores 87 lakh 50,000. In this case, it will be seen that even with 55% share, the owner gets only 13,070 into 2.5 is equal to rupees 34,370 per square meter, which is too low when compared to rupees 65,000 square meter in Kavadiya. Here it is for the landowner to decide as to opt for compensation under Land Acquisition Act or to take TDR right for plot. Case 2. Find out the value of TDR for a plot at Vaturkavu usable at PTP Nagar housing scheme. Land rate at Vaturkavu is 15,000 per square meter and FSI 1. Land rate at PTP Nagar housing scheme is 35,000 square meter and FSI is 1. Plot area is 3,000 and plot is residential. Here, since the land rate at the originating plot is less than the land rate in the receiving plot, rupees 35,000 square meter, is taken as base and respective shares are allotted. So 20% for a receiving plot owner, rupees 35,000 to 0.2 is equal to rupees 7,000 per square meter royalty. 35,000 the originally owner, 35,000 to 0.35, 12,250 per square meter, and 45% for development for 35,000 to 45 is equal to 15,750 per square meter. Value of TDR to plot owner is equal to 3,000 into the FSI is 1 into the rate, rupees 12,250 per square meter is equal to 3 crores 67 lakhs and 50,000. Here, since the originating plot has a lower land value than the receiving plot, loss and compensation value to the plot owner is marginal. Instead of a rate of 15,000 per square meter, owner gets rupees 12,250. This you will have to study carefully and decide. The present chapter, Valuation of Properties of Beginners, Part 5, is being completed here. The next chapter, comprising valuation of property as per market approach, the cost approach as per international valuation standard, is explained in detail in my next presentation, Property Valuation Beginners, for part 6, which will be uploaded soon. I extend my courtesy and gratitude to Sri R.K. Gandhi, Sri Smilis Datta, and Sri B. Kanakasabhabadi for certain extract taken from their book on valuation. Hope this presentation is helpful to you. Please express your frank opinion, your likes and dislikes about this presentation. Also, I request you to subscribe my channel. Thank you.